Hello, welcome back. We're going to talk about Tencent, a company that I would love to hold in my portfolio at some point. I think it's a very interesting one to hold right now. And it has been going down. Again, with the rest of the Chinese stocks, has been going down significantly, about 38%. Now, companies like Alibaba, for example, or JD, for instance, they have gone down even more than this. But still, we need to see whether this is overvalued or not, or it's in undervalued territory, and see whether it makes any sense to buy right now. If you take a look at the financial metrics of the company here, the initial ones, you will see that the P ratio and price to free cash flow ratio are very close to each other, 14.7 and 15.8. Both of these are pretty low here, again, for a company of this sort. And to take a look at the chart, it almost shows the same trajectory here, going down and down. And this, of course, you obviously love to see. Outstanding shares that are slightly more than what they used to be, but not tremendously more. This may look steep, but in terms of the numbers, it's just a little bit of extra dilution here, 1%. I'm okay with this one. It's more, but not too much really. So I'm really okay with this one. Total liabilities to free cash flow doesn't look too much, so this means that the company is pretty solvent here. They do make quite some free cash flow to pay back all the total liabilities that they have in the next 4.2 years. So that's great. It means that they are very solvent really. And take a look at this revenue growth, net income growth, and free cash flow growth here, as well as the total equity growth without even issuing many shares. They keep increasing like crazy here. Their key metrics, the key financial metrics here. And they have some other great things about this company. Great gross profit and net income margins here. These are amazing. And you will see that the returns on equity, return on capital employed are actually pretty great, sitting near 20. This is what Alibaba used to be before they had the last year in which they lost some net income on some of their investments, and this is why their return on capital employed went down. I made a full video about this one. It's a very interesting one. I'll see to link this one actually at the end of this video, so you may want to take a look at it when this is done. It's gonna provide some very nice insight about how to actually analyze a situation of this sort, because just by looking at this on face value, you could think that Tencent is a much better opportunity, and it is a great opportunity, but in terms of it being better or worse than Alibaba, you shouldn't just take a look at this return on investment values here, but overall examine what the company is doing. Now, great stuff on margins here, which obviously I love to see. You will see a little bit of redness here in terms of our dividends, but remember, these are the last 12-month dividend yield. This is 4% for the last 12 months, and so we always kind of want to take a look at our dividends module here, in which you will see that they paid this extra dividend here, which was a one-off. Normally they pay much less, and you will see that the effective dividend yield right now, that is how much we are making right now based on the very recent one that they paid, is 0.45%, so it's much more solvent than the 3.9, which is the last 12-month one. You can kind of see the full breakdown here. And so practically speaking, if you go back to our stock analysis page here, this 50 and 60% here values, 56 and 62, will practically be close to like 10 or even 5% potentially, indicating that the company doesn't have any problems with paying their dividend, which is going to be much less than this, of course, in the upcoming years. 0.5%, something of that sort, is what it's going to be. Now, the thing that we want to kind of take a little bit of a look at is just quickly take a peek at what they're doing in terms of revenue, increasing the revenues tremendously here, and the same thing with their net income, tripling it and then some. And so their balance sheet, even though they haven't actually issued too many shares really, they have issued some, but not too many. You will see that their total equity has been growing tremendously, from 43 almost billion to 138. This, of course, is not about the stock that they issued, which was like 1% of the total float. It's that the fact that the company is making very good money really from their operations. And if you take a look at the cash flow statement, you will see that the net income is laid out here, and we are arriving to from 16 to 27 billion in terms of operating activities and cash flow, and the free cash flow is also getting increased, more than doubling itself over the years, doing very well as well. And the company has been financing themselves a little bit, getting a little bit of debt, but remember, they were extra solvent. They don't have a lot of debt, and so this is great to see for the company. Now, Of course, remember that we examined that in our in our stock analysis chart here, where we examined the total liabilities to free cash flow, which means that 4 times of last year's free cash flow is enough to pay all the total liabilities that the company has. And again, this is very, very solvent, obviously, and the debt to equity ratio that is very, very low, meaning that for every $0.3 of debt, the company has $1 of equity, really, and so that's more than sustainable. You'll see here, if you take a look, that typically anything less than 1 is normally fine, although we don't really want to be close to 1, practically speaking. In some situations, it could be fine. There are companies that are more than 1 and they are still great companies. It really depends on the structure that they elect to choose, but we need to be aware about this and analyze. Now we will take a little bit of a look, of course, at what is very, very important, and that will be our stock evaluation tool, because we want to see how much it makes sense for us to buy the company for. And the revenue growth that I'm going to be going for is going to be relatively low based on what the company has been doing. We're going to go 10, 12, and 14 for our estimates here. Net income margins, I'm going to go in between. These are a little bit of a large range here, from 30 to 40. I'm going to go exactly in between 30, 35 and 40 here in terms of our margins. And the free cash flow margin is going to be about 80%, 85, 77. Remember, that is a free cash flow margin compared to net income, not revenue growth. And so if we go, let's just say let's just go 75, 80 and 85, that would be 75 of this 30% really. Okay, so annual return of 13% is what we should be going for. Typically is what I want to be getting out of any single stock, because remember, when you're investing in a single company, you have more risk than investing in an ETF, for example, where the risk is spread out into various instruments, really. Investing instruments. So this one is just a single one, and I want to be making a little bit more just for the effort and the risk I'm taking. So hit calculate here, and we're getting that for our medium or high estimates, we're already there. Our low ones are slightly off, but almost there. So our current price is sitting at 45, our low estimates are at 42. We're not far from that. And so, of course, if we're like near 40, I guess it would be even better. But even at this current price, I feel that buying Tencent is not a bad idea. Looks like it's a company that will continue doing well, and our estimates are very fair here. Even this one, like the first one, this net income margin may be actually a little bit low, although that's what they have been doing in terms of their 5-year average. You can kind of see it here. It's just that the last couple of years it has increased significantly more than 30%. So this has caused the influx here in terms of the last year, and sort of like the increase in the 3-year average. So yeah, that's what I wanted to talk about in terms of Tencent. It's a great company. It is a company that I am looking to add to my portfolio. I do like to get steep discounts, so I think that Baba may be, actually it is, cheaper than this one. But this is another great company that it may really be worthwhile adding to a portfolio. So I would definitely consider this one for an addition to a portfolio. It has been down, remember, tremendously. It used to be like $100 or so at some point, and the 1-year high has been 73. So as it's going down, it may be entering an even steeper value territory here, and maybe a fantastic buy right here. Thanks for watching again. Remember to leave a like and subscribe, that helps a lot. And I'll see you in the next video, guys. Bye bye.